Mortgage rates just rose to the highest level that we've seen in 2023, with mortgage interest rates soaring to 7.22% after strong economic data, primarily coming off the employment front. Now, does this mean that we're likely to see interest rates hit 10%? The reality is no, but we are going to see more and more volatility in the market, which means that interest rates may continue to move up in the meantime. Now, when it comes to the employment data, you're really getting a mixed message out there in the market, as ADP is showing that the US added nearly 500,000 jobs, which is the most in over a year. But at the same time, we're seeing initial jobless claims edge higher, in addition to the BLS showing that payrolls only rose by 209,000 jobs in June, which is actually less than expected. And on the flip side, it's showing that job growth is actually wobbling. But with that, we did see unemployment drop by 0.1% to 3.6%, which is showing the Fed that the labor market out there is still really strong. On top of that, wages actually rose 4.4% from a year ago, which is a little bit higher than expectations. And this is really something that the Fed is paying attention to, because as wages grow, that means consumers are making more money, and in turn likely to spend money, keeping inflation higher than the Fed's 2% target. Even though the labor market is really hot out there, it is finally starting to show some signs of cooling, with job openings actually falling a little bit, now sitting at 9.8 million jobs. But here's the thing, that could actually be looked at as a good thing as well as a bad thing. It's a good thing because there are jobs out there available, which means that anybody that wants a job can likely get one. If you're laid off from your job, there's a really good chance that there's another job out there for you to take advantage of. But on the flip side, the Fed looks at all of these openings as an opportunity for increased wages as these companies compete for employees, which could ultimately lead to wage inflation, which is exactly what the Fed is trying to prevent at the moment. Now, as we've seen the strong economic data and we've seen interest rates rise, we're now starting to see it hit the housing market as mortgage demand drops to the lowest level that we've seen in nearly a month. So where exactly are interest rates headed? What are we likely to see over the next couple of months? Well, that's exactly where I want to reach out to you. Give me your thoughts in the comments below. Let me know where you think interest rates are headed and tell me why. And at the same time, if you're tired of hearing me talk about interest rates, do me a favor and hit that thumbs up. No, but in all reality, if you like my videos, do me a favor and hit that thumbs up, as well as subscribe to the channel to stay updated on everything real estate related. Now, as we've discussed in the past, the market doesn't like volatility. Volatility creates big swings in the market. It creates big swings in the stock market, as well as the interest rate market. And what I mean by volatility is the Fed doing things differently than the market actually anticipates. And for the better part of 18 months, the Fed has been very transparent in all of their expectations so that they're not upsetting the market. And that's exactly why they've left the door open with the potential of more rate increases in the future as they watch the data out there in the market. And with that, the Fed actually sees more rate hikes ahead, but as they've mentioned, it's going to be a slower pace. They're not going to necessarily hike like they have over the last year. In fact, the last Fed minutes actually revealed that there were some divisions on whether or not they should actually pause in June, as there were actually Fed members at that time looking to do another 0.25% increase. At the moment, the minutes are signaling that the Fed is likely to raise by another 0.25% in the July meeting, as the July Fed rate hike remains largely priced in. But here's the good news. Expectations for a September or a November rate hike have actually pulled back somewhat. At the moment, Fed funds traders are actually pricing in a 90+% probability that the Fed is going to hike by another 0.25% in July, which will take the Fed funds rate up to 5.5%. And because the market is largely pricing in this move already, that means that you've probably already seen it built into the current market. So as the Fed raises interest rates once again in July, you're not likely to see any big moves in mortgage rates at that time. In fact, you could actually see interest rates pull back a little bit with regards to their stance changing at all on that one additional hike. But on the flip side, if they come out and say that they could see even more increases coming, well, that in turn could drive interest rates even higher, which could lead to even further slowing in the housing market. Now, for a long time, I was out here saying that as inflation comes down, you're likely to see mortgage rates follow. But what we've seen is we've actually seen inflation come down, but we've seen mortgage rates actually go up. And that's largely due to the fact that the economic data data out there shows that the overall economy remains really, really strong, as private sector companies added nearly 497,000 jobs in June, which is more than double the expectations. So here's where I stand on interest rates at the moment. I now personally believe that interest rates are likely to stay higher for longer because for the foreseeable future, I don't see any huge changes happening with the data. But with that said, I also don't see any huge changes happening in the housing market other than a further slowdown, which means less closed transactions taking place. And that's primarily due to the lack of supply that we've actually been talking about over the last couple of years. And that's largely why the US has actually been able to avoid the crash expectations that have been floating around the internet, because that lack of supply is actually keeping prices high. On top of that, 1/3 of home buyers are still paying in cash, which means they're not being affected by higher interest rates. And another thing to keep in mind is 42% of Americans actually own their homes free and clear, in addition to 90% of the other 58% out there having interest rates in the low 3 to 4% range, which is further locking them into their properties. So the reality is housing affordability is likely to continue getting worse over the next couple of months because of increased mortgage rates and price stabilization in the market. So as I always say, buy when it's the right time in your life. Make sure you have that longer term time horizon. Make sure you have money in the bank. Make sure you're comfortable with that monthly payment, and make sure you're buying because that's what you want to do. Or on the flip side, don't buy because that's what you want to do. But ultimately, you make the decision. Don't let YouTubers like myself or anyone else out there dictate what you decide to do.